So this webinar is how we choose stocks. We're really excited to have everybody join us. We've done this webinar in the past a few times. It's one of our most requested and most sought after presentations. So we're excited. We've got a good group of information here, a good group of individuals to share some knowledge. So thank you all for attending. Hopefully you find at least one nugget of information that's useful to you and you can take away, and we'll have a recording on this afterwards if you need to rewatch it and take some more notes. So really the goal of today's webinar, we've got so many different strategies that we use here at Fort Pitt. We've got dividend strategies, growth strategies, bond strategies, mutual fund strategies, so many different options, and those fit into your portfolio in different ways. But this one, people always ask us, how do we find the stocks that we add to our portfolio? So we've been doing this really since we started this firm, and it's great that we can use our team to kind of almost Wizard of Oz, have a peek behind the curtains on how we choose some of the stocks. So that's what today's topic is going to be about. So please ask questions. A little bit about our webinars. We've seen a lot of familiar faces on, or I should say familiar names on the registration list. But for people that haven't joined, we do webinars very often now. So we try to do a couple a month, and we do it to educate the community and make sure everybody has some good knowledge on what we're doing. And we get feedback from folks like you that if you have topics that are important, share it with us, because we are always looking for some good ideas to share with everyone. We'll just do some house cleaning things. If you are on a mobile device, questions at the bottom there. We've got a ton of questions already, but please send in your questions. We probably won't get to everybody, but someone will be able to reach out to you at some point too. But we definitely want as many questions as you have. If you are on a computer, you can see on the right-hand side, there are where the handouts are, and any questions that you want to throw into the chat there. You can minimize the box with that orange and white arrow there. So brief history about our firm is we are many things, but at a core, we are a planning firm. So we like to understand where all your goals are, and we use that to invest your money in an appropriate solution. So we're very fortunate that we have an in-house management team. We've got 3 individuals here, which you'll learn about. They're just part of the team. We've got a planning team as well. We've got back office and marketing. We've got a lot of great support here to help us do our job the best we can. But the nice thing is we do have that boutique feel where it's not as if you're at a huge firm where you don't even know your person's name. So a lot of times we like to include people to have you understand that there are real life people looking after your money, and we take that serious. It's not a robot that's pushing the numbers there, at least not anytime yet. And we really pride ourselves on customer service. So that's something that we've always done for sure. So about myself, I guess just a quick background on me. I really have been an investor my whole life, since I've been 8 years old, when I got some shares of McDonald's for Christmas that I thought was a terrible Christmas gift, but it's really the only gift as a kid that I still have today. So really fortunate to be interested in the market and get to pass that along. So I'm a certified financial planner and advisor here with the firm, and I live in the South Hills with my beautiful wife and 2 kids. And I'll introduce my co-host here, Rico.
Thank you, Skylar. Like Skylar, I'm an advisor here with the firm and also a certified financial planner. Been with Fort Pitt for going on about 5 years, and born and raised South Hills, still live there now with my lovely girlfriend and our dog. But very interesting topic today. I think this is a really good forum to see all of the people at Fort Pitt that are really working to build, accomplish your goals, objectives, all that sort of stuff. And this is a good forum to tie us as advisors and our portfolio management team, which we love having that capability in-house. But let me dive into introductions. I know we have a packed agenda today. We'll start with Dan our CIO and partner. Dan, could you tell us a little bit more about your focus and what got you interested in investing.
Sure. Thanks for the question, Rico. In terms of my focus, I'd say at a high level, it's really formulating our market views, our asset allocation decisions, overseeing our various investment strategies. And, I spent a lot of time working closely with our advisors and clients to explain our philosophy and our thought process. But just like Brian and Chris, who you'll hear from, I'm an analyst as well. So I'm closely following the companies that we're investing in, researching new investment ideas. As far as what got me interested in the business, I think it would really be, kind of my early days working directly with entrepreneurs, really seeing how they thought about the world. Just got me interested in the concept of owning businesses. And as I learned more about, the stock market in my college days, I realized it was pretty easy to invest in and own parts, very, very small parts at the time, but in great publicly traded companies. I think the path was really pretty much set from that point on.
Thanks, Dan. Brian, we manage over $5 billion for our clients. It's a lot of work to go around. What does your day-to-day look like, and what got you interested in investing as well?
Yeah, Rico, thank you. Thank you, everyone, for joining this webinar. We're really looking forward to covering some great stuff. So in terms of my day-to-day activities, I really see myself as wearing two hats. One is aiding in the formulation of investment ideas, and then the second is ensuring our clients get exposure to those investment ideas. So the first part really relates to investment research and recommendations. And as Dan alluded to, it's him, Chris, and myself and other analysts on the team really working closely to not only monitor our current investments, but then seek out and investigate new investment opportunities. The second part then relates to really the execution of portfolio management. So that's ensuring that all the appropriate clients get invested in our best ideas in both a timely and cost-effective manner. So I really work closely with our traders and other junior analysts to make sure our portfolios are aligned and remain aligned with our best ideas.
Thanks for that, Brian. And I think, to your point on wearing a lot of hats, that team environment that we have is very powerful, and it allows you guys to really leverage your strengths. So, Chris, tell us a little bit how you got started and what your day-to-day looks like.
Yeah, sure. Thank you, Rico. And thank you for everyone for joining the webinar. There's a lot of good information, so I hope you guys take notes and have some good takeaways from it. So believe it or not, I've been interested in the stock market since I was about 16 years old. I opened my Roth IRA as soon as I turned 18. I've always had an interest in learning, trading, making money, finding different ways to make money. And in this industry, there's thousands of businesses and ever-changing markets to analyze. So it keeps you very busy and sharp as you study different industries and sectors and people. So the concept of being able to compound your wealth over the long term has just been a fascination of mine. And one of my big ideas or beliefs personally is that everyone should have a basic financial education and stability, because really at the end of the day, it's on you as an individual to take your finances into your own hands. So my day-to-day at Fort Pitt on the asset management team consists of research and analysis on our current holdings, brainstorming new ideas for the portfolio models with Dan and Brian and the rest of the team, and answering advisor questions, research reports on securities, and assisting in implementing our strategies for new clients and current clients as they come on board or as we run global trades.
Yeah, I think that's fantastic. And I know I'll speak for Rico, myself, and all the advisors. We love being able to reach out to you or anybody on the team with questions from ourselves or our clients. So it's great having those resources so close. So let's kind of get to it, Dan. What is our approach here at Fort Pitt for choosing stocks on a high level?
Yeah, a lot I could cover there, but I think first, we're huge believers in counseling our clients to earn the equity premium. And that's just kind of a fancy way of saying that over a reasonable time horizon, the owners of good businesses are going to earn a higher rate of return for a premium compared to the bondholders or to the lenders, to those companies. So, earning and compounding that premium over a long period of time, over decades, can be extremely powerful. Also, we think about the world and make investment decisions through the lens of a business owner. So stocks or equity investments in businesses are long duration assets, and we feel that we should have a long duration mindset when we make those decisions on how to allocate our clients' capital. So we want to understand the businesses that we invest in. We want to understand the management team's vision for the business. And we recognize that it often takes, a considerable amount of time for management to implement their plan. So much more, patient, long-term focused approach compared to the mentality of a stock trader, which we are not. So at the end of the day, we want to own great businesses that have structural advantages over their competitors and management teams that we're confident in. And we think that the price that we pay for those businesses is really a key component of our success. So, the valuation process is a very important part of our overall investment process as well.
Perfect. No, I think that's great. And a lot of people maybe think that buying a stock is more risky than other types of investments. So you like to build diversified portfolios. So tell me, how many stocks do you typically hold in one of our models at the firm, and what sort of time frame do you take on those investments?
Yeah, good question. So, first, we certainly are. I mean, it kind of goes without saying, but we are believers in diversification and spreading out our risk across, different market sectors, avoiding situations where, unexpected negative outcomes with one or two of our stocks has an extremely detrimental impact on the portfolio. But at the same time, we don't want to be overly diversified and own, invest tiny amounts of capital across hundreds of different stocks. In those situations, your portfolio sizes are just so inconsequential that even when you do have phenomenal outcomes, it just doesn't have an impact on the portfolio's bottom line. So kind of a long-winded way of saying we typically hold about 25 to 35 stocks in our strategies. And we really think that's kind of the sweet spot where we have enough diversification, but also meaningful enough position sizes to have an impact. In terms of the time frame question, we're long-term investors, so we may hold a stock for 5 or 10 years or multiple decades in certain situations. But in terms of the time frame for evaluating a stock, we're generally looking out over a 3 to 5 year time horizon to try to project the company's earnings and cash flows, and then we try to determine a fair value for the business. And kind of to dig in on that time frame a little bit more, if we use a really short time horizon for our analysis, you start to get into placing too much weight on things like next quarter's earnings results, which really just shouldn't have a huge impact on the value of a business for a long-term investor. If we use a very long-term time horizon, 10 or 20 years, there are just so many variables that can and will change that your assumptions can be just massively off. So we think that 3 to 5 year time horizon is really an appropriate time period to use.
Excellent. Perfect. Now, we mentioned we're long-term investors. Most of the clients we work with are the same. They're long-term investors. Brian, we get asked this a lot. We get asked, what type of turnover rate do we have in a portfolio? How often are we selling out of positions? What does that look like in our portfolios typically?
Fort Pitt doesn't have a singular number for which we really aim to have annual turnover at. But in general, our portfolios have a lower turnover than what I would say is most typical in other investment portfolios or funds. And I think this really ties back to kind of what Dan just covered. And The reason we have a lower than average turnover is because we believe it's prudent to give companies we invest in sufficient time to execute on those strategies, and then allow our investment theses to play out and have that reflected in the stock price. So while prudent portfolio management practices might lead us to trim a little bit here or buy a little bit there, we tend to maintain exposure to companies for many years. As Dan said, maybe around the 4 to 5 year. With that being said, we don't allow the portfolio's current turnover numbers to dictate buy-sell decisions, especially on the sell side. We're willing to have increased turnover numbers if that means we're getting the opportunity and taking the initiative to step out of names when that investment thesis no longer plays out or is no longer attractive.
Great. And I think that's wonderful, not having a mandate on how many positions you have and how long it's in there, and set sell targets. So that's really good. You can be flexible and do what you think is best. So we kind of talked about a couple of things at the high level. So let's drill down to some valuation and position sizing. So Dan, can you touch on this? What does that look like when we're evaluating a stock here at Fort Pitt? What are some of the key aspects of a business that you look for?
Sure. So the valuation process is, I kind of covered some of this already, but is focused on, estimating the company's future earnings over a certain period, and then determining what valuation to pay for those earnings. In terms of that forecast for earnings, we're generally looking over that 3 to 5 year time horizon. And to make our estimates, we're using things like the company's own historical earnings growth rate, guidance from management, industry data, and then also, our views as well to make those estimates. And in terms of how to determine a fair valuation to pay for those earnings, it's really a combination of, things like the company's own historical valuation range, a comparison to their sector peers, and we also have to account for, big macro inputs like interest rates, which just have a large impact on equity market valuations across the board. And then after, once we kind of establish our view on the fair value of the company, we're drilling down further and we're looking for, a discount to that fair value. We really use that as our target price for establishing a position in a stock. So just at a real high level, an example would be, if we determine that a stock is fundamentally worth $50 a share and we have the opportunity to buy it below that level, say at $45 a share, that gives us the margin of safety that we're looking at, in that we're able to buy a stock at a discount to its fair value. And we view that margin of safety as a way to, tilt the probabilities of success in our favor.
Thanks, Dan. And, valuation is one side of the coin. As we look at more maybe qualitative data, Chris, I know we talk about things like competitive advantage, moats. Could you dive into that a little bit more? And I know we're going to go through and give some examples and cases of names that we really like, but kick us off.
Yeah, definitely. So from an analyst perspective, the word moat and competitive advantage, they get thrown out around a lot in the investment world. So the way that we really want to tackle this is being able to quantify that advantage or moat. And this can be done through market share analysis, this margin expansion analysis, product cross-selling and net retention rates, or even the structure of long-term contracts for specific types of businesses. And one of those examples is a company we own called Air Products, and we own them in our dividend or equity income strategy. And they normally have contracts, long-term contracts for 15 to 20 years. So that's a pretty durable moat for them, and it's benefited them greatly over the decades. Pricing power is also a major advantage for a high-quality business. It allows the company to raise prices to maybe offset certain costs, or raise prices simply because, well, it's a great product, there's great demand, and they can squeeze more profit out of it for shareholders. And one of the companies that I want to use as an example as a quality company is Thermo Fisher. The healthcare landscape is very dynamic. It is always changing. So as new drugs come to market and are developed, they have to utilize diagnostic equipment, and there's very few companies that they're able to go to. Thermo Fisher is one of them. The process of kind of analyzing a company for myself starts with the underlying theme, which is healthcare. And then, because you want to invest in a market that is growing at a durable pace, and that's usually a good sign of a quality business. And healthcare market fits that description. Healthcare is a growing total addressable market as demographics age. Management in general has done a very good job at responding to the broader markets over the past few years, managing costs, which gives us, the investors in the business, confidence in management to continue to do well with the business and increase profits for shareholders. 75% of Thermo Fisher's revenue is recurring revenue, which is above the life sciences peer group average of 60%. So I would call that a relatively strong competitive moat. And this gives us the confidence and the durability through economically sensitive times for the business to do well.
Yeah, thanks for the talking points on Thermo. Dan, let's change industries. Why do we, as Fort Pitt, why are we picking up the blue bucket versus the orange bucket?
Yeah, great question. So, as you indicated, my example would be Lowe's. We like the home improvement sector in general. It gives us exposure to the U.S. consumer, which we often refer to as the eighth wonder of the world. It's an area within retail that just isn't overly exposed to online competition. When a customer wants to buy a refrigerator, they want to go look at it, compare it side by side. They want somebody to come deliver it to their house and install it. We also like the fact that the average age of a home in the U.S. is about 40 years. So there's just a lot to do, as we all know, in terms of just general upkeep and maintenance. We think Lowe's is one where a strong management team has really made a huge difference. So prior to 2008, Lowe's really wasn't an extremely well-run business in our view. It severely lagged their orange bucket competitor, Home Depot, in just about every operating metric. But in 2018, they brought in a new CEO, a gentleman by the name of Marvin Ellison, who had a successful career in retail. He spent about a decade at rival Home Depot. And we've just been really pleased with how well the new management team has turned around their operating performance. So Lowe's is now operating much more efficiently. They use their labor force much better, much stronger online presence, and they've gotten a lot of traction with their pro customers as well. So all of those improvements are really well reflected in their profitability metrics, in their earnings growth. And we think it's just a really, really good example of how well things can work when you have the right people, running a great business.
Yeah, and I think that's a fantastic example of a top-down analysis. So we find an industry or a sector that we like, and then we look amongst those names as who's doing this the best and how can we get involved. So thank you for that. Brian, we touched on two names that most of our viewers are probably familiar with. What about a name that most people may not be aware of?
Yeah, I really like a company called GXO Logistics. And this is a company that other companies pay to come in and improve their logistic operations. So the value in GXO is really the value of their knowledge and experience, something that's just not easily replicated elsewhere, establishing that moat. The more instances in which GXO works on improving logistic operations and warehouse operations, the more expertise they gain, which then in turn makes them even more valuable to the very next customer. So couple that great company with, whose value comes from what they know with a high growth industry, and I think you have a really attractive investment. This industry, I would refer to as omni-channel commerce, will only continue to grow as consumers opt for more online purchases and demand quicker and cheaper shipping. So as demand for GXO services continue to grow, GXO will have further opportunities to increase their knowledge base and widen that investment or company moat, and then, should start being reflected in the company's price. So this is really a company that I think is positioned well to kind of snowball in terms of building off of its experiences and increasing that moat around their business operations.
I agree. Thank you, Brian. Dan, after the valuation process is complete, I mean, we find a name like Thermo, GXO, Lowe's. Are we giddy and ready to jump in? Like, are we taking half positions? Tell us a little bit more about what that process looks like.
Sure. Before I answer the question, I'd kind of circle back to one of Skylar's points. We manage 4 different equity strategies. One, dividend or dividend growth focused approach. One strategy where we take fairly concentrated positions and aren't constrained by sector limitations. And then really 2 core equity strategies with very healthy weightings or balance between value and growth stocks. I'd really refer to those 2 strategies as kind of all-weather approaches. So the first step would be, after we've done our research and due diligence and we've decided that it's a company that we want to invest in, it's really deciding which strategy or strategies it's appropriate for. As I mentioned earlier, we typically hold about 25 to 35 stocks in our strategy. So an average normal target position size for us is roughly 3% of a client's overall equity allocation. Higher in some cases, slightly lower in other cases, but at a high level, you can think about that full position weighting as being around that 3% mark. There's not really a one size fits all formula for how we get to that full position weighting. I'd say a number of different factors and views involved. We've had a lot of situations where we see what we view as a complete market overreaction to a quarterly earnings announcement or just general headlines that we deem as a really good opportunity to buy the full position size all at once. Other times where we may build a position in phases over time. And I think of the kind of market environment back during the depths of the COVID pandemic as a good example. Probably the most volatile market I've experienced, even including the great financial crisis of 08 and 09. We had markets moving 5 to 7% in a day, individual stocks swinging 10 to 20% in a trading session. In that type of a market backdrop, where you think you're getting a great entry point at $50 and the stock's trading at $40 in 2 hours, it certainly is at least prudent to do your buying in stages. So I'd say it really depends on things like valuation or conviction levels and the overall market environment at the time as well.
Gotcha. Definitely a nuanced process for sure.
Right.
As investors, we all have this innate curiosity. I know you guys all have slightly different experiences with this, but where are we generating ideas? I mean, are you guys looking at your neighbor's Facebook? Do you have certain screens or models, or are you throwing a dart at a board? If you could just take us through how your individual process works. Dan, why don't you start us off?
Sure. So first, I would just kind of echo some of your comments, Rico. We do all have different approaches and slightly different processes, which I view as a big positive. But at the same time, we're all bought into the firm's very well established investment philosophy, which keeps our combined efforts well aligned. So for me, I do some screening to find new ideas, and there, I'm focused on things like high levels of free cash flow, high return on equity and return on invested capital, earnings growth, and valuations. And in that screening process, I'm really looking for situations where I find metrics that are so attractive that I'm highly motivated to learn more about the company. But other than screening, and I think this will be kind of a common theme, I read a lot, which translates into sometimes at least the outline of an idea that may lead to something worth looking into. And, just kind of thinking of an example, back in 2022, I read a lot about how, software engineers were being laid off from big tech firms like Google and Facebook, and going to work for, agricultural equipment companies like John Deere. And it really just kind of piqued my interest. And as I dug in more to the John Deere specifically, I learned how, they were really revolutionizing the agricultural space with technology and automation. So I learned about things like, autonomous driving and seed placement and remote diagnostics. So it started with just kind of reading a quick note, but after a full, analysis process, we concluded that, this is a business that we want to own. It's one that's leveraging technology extremely well. It's helping farmers increase, crop yields and lower their operating costs. And we didn't at the time, and we still don't think that those, positive attributes are fully reflected in the stock price.
So, Dan, I kind of want to take what you were saying, where this article piqued your interest and that led you down, the path for research and evaluating potential investments. And for me, what tends to pique my interest or get my attention is just real life experiences, in the day-to-day living. So, for instance, a simple solution like going to buy light bulbs at Lowe's and using my credit card. I'm always interested in kind of how industries work and how different, companies can take a different approach to the same idea. So for my example, of going to Lowe's to buy light bulbs, why did I choose to go to Lowe's versus other competitors like Home Depot or Target? Then things like the simple selection of a light bulb has so many factors that come into play: price, marketing, features. What made me buy this light bulb over the other light bulb? And then, kind of tie it all together. Why did I use my credit card? Why Visa and not MasterCard? Well, what about the other options like buy now, pay later? There's all these different decision points that, when you take a step back and really examine them, you start to wonder, what are all the different companies involved and what are all their different strategies? So that's really what piques my interest, to start digging deeper and seeing, understanding industries, understanding the different players and understanding their approaches. So, again, it's all, there's tends to be instances that pique my interest and really kind of start that process down the road of evaluation and research and valuation.
Yeah, no, that's really good from Dan and Brian. And over the years, my process has somewhat evolved, as it should, as any analyst should. You learn from others, you grow into various teams, and you get to see their processes, and you get to mesh certain criteria that you like from theirs into your own. And I sort of use an approach that has to do with themes. I like to read, so I am always seeing how sort of these secular themes you notice when you're reading are changing the landscape of certain industries. And a big one that I have latched onto over the past probably 5 to 7 years is warehouse automation and efficiency. And a company that we really like in this area is Zebra Technologies. My main process stems from looking in areas where others aren't or are out of favor. I prefer not to chase things, equities. FOMO isn't normally a great way of investing for the long term. And I like to utilize various metrics such as free cash flow per share growth over the 5, 10, 15-year periods, and see how management is using that cash to buy back shares, dividends, invest in the company, margin expansion, market share growth, share repurchase programs, as I previously discussed, and basically the overall capital allocation of the firm and where management wants to use that capital for bolt-on acquisitions. Is it beneficial? Do they want to have a little PE division where they invest in smaller companies and then buy them up at a later date? So there's a lot we could talk about here, but I would say kind of like the secular theme is mostly where I stem most of my ideas from.
I think it's great. And, we used to have like a polar bear where we'd put the orange bucket in a corner and the blue bucket and see which bucket he would pick. And that's if we'd pick Lowe's or Home Depot. So
It was
I guess
the
we don't do that anymore.
Dartboard sounds good.
It was the groundhog, Skylar. We moved
Oh,
away
that's
from the
right.
groundhog.
That's right. I knew it was some animal. Okay. So it's good that you all are making those decisions now. So we talked a lot about buying and the process that goes into that. It's sometimes just as important, maybe even more important when we're talking about selling a position. So Chris, why don't you tackle this one? Talk through the sell side analysis of our positions and why we would even sell a
So
stock.
selling a position is probably the most difficult part of the process for a portfolio manager or an analyst. So the best reason to sell a position is that it reached full potential and your thesis played out. You want that to work out at the end of the day so you can sell the position and move on to your next idea. That's the best possible outcome. That your position became too expensive relative to growth that you can no longer justify it. So you can justify moving on. Now, there are situations where owning a position that your thesis doesn't work out, and that's okay. As PMs and analysts, you have to be able to own up to that decision, sell the position for a loss, or maybe it just underperformed the market over your time frame, the 3 to 5 years, and nothing shifted in the thesis to bring that equity up to outperform your benchmark. And one of the last reasons we would sell a position is to bring down a client's capital gains towards the end of the year from maybe a losing position for the year that maybe we still like, which is most of the case, 99.99% of the time, I would argue. We would turn around, buy the security back in 30 days to avoid a wash sale for that client. So I think the one most important thing to understand on selling in the sell process is time frame is everything. You have 3, 5, 7, 10-year time frames. We're not short-term investors. So if our thesis isn't working after a year, maybe we reevaluate it a little bit. But for the most part, as long as the numbers don't change and it's underperformed for a year, we would continue to hold it. So there's been instances that we have all probably seen where it's almost like a beach ball underwater, where year 1 it underperforms, year 2 it underperforms, maybe year 3. But year 3 and 4 could be that big explosion up. And you're sort of seeing that in the market now with a couple of these equities. So being able to defend your position with sound analysis at the end of the day is critical to knowing when to move on, when to buy more. And you have to be able to have a non-biased opinion when you're valuing these equities. We can't become attached to them.
I think that's wonderful. And we talk about that all the time, kind of removing the emotion from it. It's a lot more difficult. You know, I mentioned McDonald's for me. Yeah, it's harder for me to sell McDonald's, but you guys, you run our portfolio, so you don't have any sentimental attachments. Your job is to grow the portfolio reasonably. So excellent, thank you. So we've talked a lot about some of the other metrics. We've gotten a lot of questions about just other things that we look at. So let's talk about some of the quantitative things that we look at in a business, and then also the qualitative. So Dan, why don't you go ahead and tackle the quantitative first?
Or I'd say probably the most important quantitative, factor would be trying to understand the company's long-term, growth profile. That's really going to help you to determine what valuation to pay for the business. And I'm not talking about, what the company will earn or what growth will look like next quarter, but trying to understand, is this a slow growth, mature business with limited growth prospects that would typically trade at a lower valuation, or is this a firm with new technology or a new product or service that's growing at 20 or 30% annually that would command a higher valuation. Profit margins are also something that we spend a lot of time on. How much of each dollar of sales actually flows down to the bottom line. So we're looking at things like gross margins and operating profit margins to see how well a company is able to manage those profitability levels. And we'll look at that data over different time periods, in economic expansions and also in recessions. What we want to see is really steadily rising profit over time. We want to avoid situations where in the retail sector, just to use an example, a company may post a big increase in revenue, but it's all being driven by discounting and markdowns. That's not what we're looking for. We want to see profitable growth. And then in terms of other kind of quantitative metrics, for us, it's return on equity and return on invested capital. Those are very important in our view. They really measure how well management uses investors' capital to generate and grow profits. So we want to invest in companies that have, a demonstrated track record of efficiently, allocating capital. Lots of others that we could talk about, but I'll wrap up with, I think Chris touched on this already, but kind of the capital structure or a company's, balance sheet. So we want to avoid investing in businesses that are overly leveraged, that have too much debt, which can become a major, problem when we do have an economic downturn or a recession. What we're looking for is strong balance sheets, low debt levels, which give companies the flexibility to do things like, make profitable acquisitions, increase their dividends, buy back their stock when it's cheap, and most importantly, be able to weather the storm when we do have, rough economic environments.
Yeah, that's great, and thanks for doing that. There's no one metric that you look at. It's kind of all of them pieced together, and I think that's going to be great. Brian, I want you to touch on this. I mean, this day and age, especially with the political division and social media and everything, qualitative is as important as ever.
Yeah, look, Skylar, I mean, I could make the case that qualitative factors are just as important, if not even more important than quantitative factors. Now, given the nature of qualitative factors, there's a ton of different definitions and, like you said, a ton of different opinions. But when we think of qualitative factors, when we're looking at companies, we're thinking things like company and product perception, employee tenure, employee satisfaction, characteristics of upper management. I really believe that, these type of qualitative factors are what actually leads towards success in the terms of quantitative factors. It doesn't really matter how efficiently someone can build a phone if you're not going to sell any phones because the general public has a negative perception of your company. So it's kind of really two ends of the spectrum between quantitative and qualitative. And we always try to look at them together, look at them in sync, see how one is driving the other.
Yeah, Brian, I couldn't agree more. You can find a qualitative, talking point or thought that you can tie back to the numbers, or a number that you can find a root cause, whether it be, hey, great employee retention, great sales force, that kind of stuff. I know we touched on position sizing, but with markets, they're always moving. One could make the argument that they're moving faster than ever with algorithms, all the technology that's in the industry now. How do we time that out? Chris?
Yeah, so I think this is one of the big differences between individual investors and institutional investors. I won't make the case that it's too hard for an individual investor to identify good companies, but from what I've seen, sometimes it's a bit of a challenge for some individual investors to identify a good company, and then also to identify a good entry point for that company, and have the discipline to be patient enough to wait for that entry point itself. This kind of goes back to having no emotion about when to buy it, because you could see a stock going down 10% a day like it was during COVID for 5 days in a row, or it could go up 10% a week for 4 weeks at a time. So to answer your question, we have to be patient, and we have to wait for that intersection of where a good company reaches our target price and the probabilities start to get skewed in our favor for success down the road, 3, 5, 7 year timeframes.
Yeah, I'll just jump in with some commentary there. I think that patience part is not always easy, right? A lot of times the opportunity comes to us in periods of, market stress, and often when there's fear in markets, and that's when it's extremely beneficial to have already done, the fundamental research and analysis, and to be confident in, the value of a business. It really helps investors to be able to step in and say, the current market panic has opened up a good buying opportunity for us as long-term investors.
Yeah, thanks, Dan. And markets are moving day to day, every minute of every hour. But we also have those economic shifts that are a little bit longer term. how do we manage those shifts, whether they be short-term, medium-term, long-term? What does that look like for you guys, Dan?
Yeah, I think it's a really great question, and one that we could talk a lot about. But first, I think it's really important for investors to understand that there are economic cycles which do include things like recessions. And from what I've experienced through my career, it's the investors that try to outsmart the market and abandon their well-established investment plans during periods of economic downturns or market stress. They're usually the ones that end up in far worse shape than long-term investors that really stick to the game plan in periods of market downturn. So, an economic view may influence our decisions around how we allocate capital across sectors, but I also think it's important to point out, how difficult it is to really spot an economic shift or a turn. So, an official recession isn't even usually declared until we're halfway through it. And I think that the current environment is really a good example of my point. So, economists have been kind of unanimously calling for a recession over the last 2+ years. It hasn't happened, and in fact, the market is at or very near all-time highs. So instead of trying to time an economic downturn, we focus on things like investing in high-quality businesses that really have the financial strength to weather those economic storms. We also want to have some exposure to more defensive areas of the market, like healthcare or consumer staples that may not keep pace with the market when it's screaming higher, but really do provide some ballast and stability on the downside. And also, and I know Skylar, Rico, this is a big focus of yours, but for clients living off their portfolios or close to making that transition, we want to have, call it 3 to 5 years worth of their cash flow needs allocated to lower volatility asset classes like cash and bonds. So if we do, or when we do get into a situation where we have even a severe long-lasting market downturn, our clients aren't forced to sell their stocks at depressed levels to fund retirement spending. We already have that taken care of, and have it taken care of for a significant period of time, which really gives us the flexibility to be patient and wait for things to recover. So I know the question wasn't directly about investing through a recession, but that's obviously the outcome where investors feel the most pain, and also where investors are more likely to make the big impactful mistakes. So I think it helps to kind of look back at history, right? If we look back to the last 100 years, we can see that bear markets are usually fairly short in terms of duration. The length of the average bear market has been a little over a year. The broad market decline has been, let's call it 35%. So certainly not a pleasant outcome for investors, but those bear markets are also what really sets the stage for the next bull market, which, again, looking back to history, those last a whole lot longer. The average duration of a bull market has been about 7 years, and the average cumulative return has been about 340%. So when those bear markets happen, we really need to guide and counsel our clients that you need to be able to look over the horizon. You need to be able to make sure you're still in the game for the bull market that follows.
Yeah, that was a great breakdown, Dan. And I think one of the biggest areas to manage the economic cycles, to build a little more, is the client profile risk as well. Skylar and Rico, you do this on the daily basis, assessing client profile risk. And maybe there's clients who are a little more conservative or near retirement, and they're in the preservation phase of their life. And maybe they are 25% equity because they want a little bit of growth. And then maybe they're 75% fixed income and cash to live and travel the world or pay their expenses. And that equity aspect gives you exposure to the long-term growth, because 75% of the time the markets are up, 25% of the time the markets are down. So the fixed income portion gives you that durability and safety net of cash flow to live on and supplement your income. So mixed allocation models are kind of the key to managing through an economic cycle, because at the end of the day, there are different profiles out there that we need to be aware of. And if you try to time and manage economic cycles, stock market cycles, whatever you want to call it, the odds just point to it not working out. I mean, there are times when the stock market and the underlying economy are completely dislocated, and it's like a puzzle that we have to kind of put together. And this could present opportunities over time for long positions or short positions. And it really goes back to your fundamental view on the companies you're investing in. Has this economic backdrop changed our view of the companies that we're investing in, or our margin of safety?
Yeah, Dan and Chris, thanks for that. And I'm glad you mentioned the client. I mean, that's why we're all here. Everyone on this call is working in unison to provide solutions. That's the way we look at our investment strategies. But as you guys know, and as you know, Skylar, our team could build the best strategy, but it might not work for a specific client. What are the types of things that you and I are counseling and questions that we answer for those individuals?
Well, it's always easier to kind of have this discussion before anything, goes haywire, like COVID or anything like that, where there's no emotion. So that's where the planning comes in, right? So we sit down ahead of time with our clients and potential clients of what their short-term and long-term goals are, and to both of your points, how much cash flow do you need per year from the account? So when we were talking to our clients during COVID, when it was going down, we had a certain amount of money out of the market, and we could be patient until it returned to where it would be, and it returned pretty quickly in that case. That's why we also are fortunate that there are other types of strategies out there that we already mentioned, the dividend growth strategy, the unconstrained growth strategy, and why sometimes we use mutual funds or bonds or bond funds as well. So all of those things get back to the client. So we've got about 10 more minutes or so, and it looks like we did this on one of the handful of sunny days in Pennsylvania. So Dan, I hope you don't melt with the sun. So a couple more questions that came in. Brian, I want to ask one of this to you. So right now we're really seeing a lot of stocks that just seem to go up and up and up. And sometimes we see stocks that go down and we think, what the heck's going on with that? Talk about the difference between momentum and long-term investing.
Yeah, I mean, momentum is a strong factor, but it can be strong going up. It can be just as strong, if not worse, going down. And, I think the importance is to differentiate between being a momentum investor and being a long-term investor focused on fundamentals, us being in the latter case of that. But that doesn't mean we can't utilize and leverage momentum in our portfolio management process. So let's take the example again, as we brought up a couple times, just the market during COVID. We saw extreme momentum to the downside. And we've seen the market drop almost 30% over the course of 19 days. And, there, of course, were a lot of questions and a lot of concerns going on in the market, but being able to, again, step back and understand that we're long-term investors using fundamental approaches, as Dan alluded to, having that backup of already having done the research and analysis and, target price identification, we as long-term investors can take advantage of those times where stocks just seem to be moving on momentum and not fundamentals, to add positions to portfolios. So like I said, the momentum factor can be very strong, up or down. And, while we don't let that guide and drive our investment and portfolio management process, we definitely leverage it a little bit to ties in nicely with our long-term fundamental approach.
Yeah, great, thank you. And another one that we've got a lot of questions on is about the current rate environment. A lot of us have been spoiled over the last 20 years. Some of us were not even alive when rates were this high, and a lot of times our parents are saying, "Oh boy, I had a mortgage and it was 17%, 6% is nothing." So, Chris, I think you're perfect for this. So, what do you think about rates and how that impacts your stock valuation?
Yeah, I think I've seen so many rate cycles. I think I'm the perfect person to answer this question. But at the end of the day, higher rates in return should slow growth. So an idea of that is, you're not going to want to pay 8 to 10% on a used auto loan, let alone probably the 12% it's at right now. I know I don't want to do that. So in theory, it's going to curb your demand or my demand on buying a car to slow inflation. And that's sort of been the Fed's goal with this. And so far, it has been working. Now, has the higher rate environment changed my views on businesses we own? Not necessarily. There may be some short-term blips in price action adjustment, real estate, for instance, because real estate over the years has benefited, last 13, 14 years has benefited from essentially 0% rates. So the fear of having to refi debt at a higher interest rate is a rightfully so fear. So real estate investment trusts, publicly traded, corrected relatively far. And we as in the asset management team might make the decision that it's not worth it to sell it, but look, rates are leveling out a little bit. The Fed seems like they're done hiking. They're not jumping on rate cuts yet, but if rates are sort of peaking here, maybe real estate's sort of bottom. So it definitely is sector dependent on how you want to incorporate the interest rate impact on your models and your valuations. But for the most part, if you told me in 2023 that the S&P did 23, 24, 26% with rates at 5% plus, probably would have taken the opposite side of that because that's kind of crazy. But here we are, and hindsight 2020, we can pinpoint why it did what it did: artificial intelligence, large cap tech stocks, et cetera, et cetera. And honestly, it just brings home to the point on why you should stay invested in the capital markets for the long term. Because if you went all cash last year, because you could get 5% on a money market, you just missed out on 23%, 26% in the equity markets. So the probabilities just aren't in your favor. And it goes back to your McDonald's, Skylar. I mean, how many years have you had that? And if you sold, you would have missed out on it. Granted, McDonald's could have gone to zero. We don't know, but their fast food's pretty tasty. So
right.
I go there once every 3 months, I think, maybe.
Yeah, the breakfast sausage biscuits go to, right? You gotta have that.
Yeah, and I'll just jump in there too, Skylar. And sorry about the sun. Hopefully there's not a glare from my head here. But overall, pretty surprised with how well the market has handled, more than 500 basis points of interest rate hikes over a pretty short, 18-month time period. We did have that 20% broad market decline in 2022, but it certainly could have been a whole lot worse. I think the markets have really just looked past these higher interest rates with the assumption that they're not here for long. We have been pleased with the progress that's been made on the inflation front. We think that there's more to go there, and we do expect that the Fed will be lowering interest rates at some point in 2024. So we'll see how things progress there. But the higher interest rate environment just really hasn't changed our process dramatically. And if we look back to what really got punished mainly in 2022 as a result of the spike in rates, it was really the newer, more speculative, unprofitable tech companies, and also smaller caps companies that are more heavily dependent on the debt markets for financing. So with our focus on high quality businesses, we were largely able to sidestep those 60, 70, 80% declines in 2022 for some of the lower quality stocks.
Well, excellent. Well, we're right at an hour, so I want to make sure we talk about the upcoming webinars. So end of the month, when to hire or fire an advisor. So make sure you tune into that and end up on the right end of the spectrum there. And then this is perfect based on what we talked about here: tax conscious investing and planning, and how best to position yourself for that. So we really appreciate you. I know, Rico, thank you for joining. Dan, Brian, Chris. So do you have any final remarks, Rico?
Yeah, I want to thank everyone for their time and attention. I know we covered a lot, and again, this is something that we could go on for hours and hours about. But for any of the viewers that are sitting there looking at their statements and just trying to make sense of all of it, Am I properly diversified? Are these investments correlated with my goals? All those sorts of things. Those are questions that we love to answer and really get excited about. So please reach out, ask those questions. Our contact information is there, but yeah, thanks again.
Yeah, we had a lot of good questions. We had a handful that we didn't get to, and some that came in the chat that we touched on that we didn't get to as well. So we will follow up. If you're a client, your advisor team will reach out. If you're not, Rico, myself, someone else here at the firm will reach out to make sure that your questions are answered. So we appreciate you all for spending your lunch hour with us. Have a great day, everybody.
Thanks, everyone.